2022 was a year that most investors would like to forget. With 2 more trading days left, the world stock market's fallen 19%, the worst annual performance in 15 years. The world bond market fell 16%, the worst performance since records began 30 years ago. Commodities did well in the first half of the year, but have since given up most of their gains. These traditional assets did poorly, but the newfangled thematic investing did even worse. Wind energy is down 25%, robotics down 40%, ESG is down 25%, and blockchain is down 85%. Macro hedge funds, bucking the general trend, had a banner year, with many generating returns north of 20%. Because macro investing thrives on volatility, divergence, conflicts, and bad policies that place policymakers on the bad foot. Is macro investing the new game in town, or should we treat 2022 as a freak year? What are the key macro themes for 2023? What do they mean for markets? And how can you make the most out of them? Hi, I'm David Wu, a former Wall Street strategist with a 20-year track record making actionable predictions about major global change. Welcome to The Money Game, where I take on groupthink, propaganda, and conspiracy theories in my critical analysis of markets, economics, and politics. Before we begin, please hit subscribe and the bell button so that you'll be notified when a new video comes out. Past performance is not a guarantee of future returns. That is well known. However, there are good reasons to think that the 2 key drivers of markets in 2022, divergence and conflicts, will remain in place if not become even more extreme. Below, I set out 3 macro themes with my predictions. Earlier this month, the Chinese government embarked on a risky public health policy that another country would have brought down a government, especially a democratically elected one. They decided to go for herd immunity. I said herd immunity only because on the eve of the termination of China's now infamous zero-tolerance policy, the vast majority of the Chinese people have never been infected by the disease. Moreover, most of the population didn't even have access to the mRNA vaccines. Putting it plainly, it's as though China woke up one morning and decided to just live with a virus that it has spent 3 years trying to defeat. It is not clear what prompted the Chinese leadership to change course. Some people might attribute it to the student protests, but I suspect the protests were just an excuse for Beijing to gracefully climb down a ladder that was clearly leading China nowhere. Nevertheless, it is a gamble. Even though Beijing has suspended the testing of asymptomatic cases, and despite Beijing having changed the definition of death caused by the virus, if millions of Chinese people were to suddenly die in the streets, Xi Jinping would not be able to escape culpability. Neither would the Communist Party. But so far, this does not appear to be the case. The deaths simply aren't there. Maybe it is proof of Omicron's relative mildness. Maybe families in China are working around the clock to keep their elderly out of harm's way. Or maybe the Chinese government is really good at hiding dead bodies. For our purpose, it doesn't matter what the reason is. The facts on the table suggest that the economic risk associated with the worst-case scenario has substantially subsided. Moreover, we could be looking at a potentially quick-in, quick-out situation. The more people see other people getting back on their feet after a week or 2 of catching the virus, the more likely they will venture out and subject themselves to the risk of getting infected. This is why I'm willing to entertain giving the benefit of doubt to the Chinese government when it announced earlier this week that the infection will peak by the 2nd week of January. If this turns out to be the case, then the Chinese New Year that begins on January 22nd will be an occasion for celebration. Confidence will return. People will be back on the move, at least within China. They will dine out more and spend more money. My daily survey of Chinese households with Rewe, a leading Canadian online survey technology firm, shows a sharp rebound in financial optimism over the past 2 weeks, if not yet a rebound in spending. Reacceleration in Chinese growth will be supportive for commodity prices, the Chinese travel sector, and the economies in Southeast Asia that stand out as being likely the biggest beneficiary of stronger Chinese demand. In contrast, it will be a headwind for U.S. assets. China's reopening will be clearly reflationary for the world economy and could force the Federal Reserve to keep interest rates higher for longer. This will be bearish for both U.S. bonds and stocks. 2023 will see more decoupling between the two largest economies in the world and more economic divergence between them. Decoupling and divergence mean more volatility. Earlier this month, General Valery Zaluzhny, the head of Ukraine's armed forces, in an interview with Economist magazine, suggested that Russia is massing men and arms for a new offensive. He predicted the offensive could come as early as January, or as late as the spring. Last week, a day after Putin said that he was open to peace talks, the Russian Foreign Minister Sergei Lavrov issued an ultimatum to Ukraine. He called on Kiev to fulfill the Russian demands. Otherwise, he said, the issue will be decided by the Russian army. We cannot rule out that Ukraine is playing up the possibility of a Russian offensive in order to get more arms and money from the US and Europe. However, why would Russia issue an ultimatum if it wasn't prepared to attack? A long drawn-out stalemate is not to the advantage of Russia. Ukraine's backers have much deeper pockets than Russia. In just 9 months, the US alone has approved $110 billion of aid to Ukraine, about double of what Russia spends on its entire military budget a year. And then there is, of course, the Russian economy. Thanks to Russia's strong external balance and fiscal position, the Russian economy has so far held up well against Western sanctions and has managed to maintain its overall oil export by selling more to China, India, and Turkey. However, a long war and sanctions will be detrimental for Russia's economic growth and accelerate the brain drain to the West. A long war will sap Putin's support at home and among allies. So how can Putin end the war on his own terms? The only way is by convincing the West that Ukraine stands no chance of winning the war. And the only way to achieve this is by defeating Ukraine decisively in the battlefield. The Ukrainian counteroffensives in the fall allowed Kiev to recapture Kharkiv province and Kherson city, but this came at the price of huge losses and depleted stockpiles of equipment and ammunition. General Zaluzhny admitted in his Economist interview that Ukraine is in desperate need of resources to counter the coming Russian offensive. He mentioned 300 tanks, 600 and 700 infantry fighting vehicles, 500 howitzers. Putin may not want to give Zelensky time to secure his resource requirements. Winter offers some advantages to Putin. Russia could deploy its air superiority more effectively against fortified positions and trench lines that would be deprived of the cover of ground foliage and are easier to spot against snow. Also, frozen ground makes it more difficult for retreating defenders to dig new trenches or dugouts. The most significant clue we have that Russia is getting ready for an offensive is the near constant attacks on the Ukrainian energy grid over the past month. With about half of the trains in Ukraine operated on electric power, this is likely designed to hamper Kiev's ability to supply the front lines and move resources and equipment. What would be the impact of the coming Russian offensive on financial markets? If we are to use what happened in the immediate aftermath of the Russian invasion in February as a guide, this should be bullish for oil, bearish for the euro, and bearish for the global stock market. In 2022, investors began to contemplate the possibility of stagflation. In 2023, I suspect stagflation will become the reality, at least in Europe and in the United States. Stagflation means different things to different people. For me, stagflation means a deterioration in the growth and inflation trade-off. That is, a lower equilibrium growth rate becomes necessary to achieve the central bank's goal of price stability. There are 4 reasons why the conditions for stagflation are already in place. 1, as I discussed in a previous video, the reshoring of jobs back to the US, mainly out of China, hit a record high last year. The trend is expected to continue in the US and accelerate in Europe in 2023. The problem is that this is happening at a time of shortage of skilled labor in the US and Europe. What this means is that the result of reshoring will be simply higher wages rather than higher output for these economies. 2, in the US, labor participation rate has not returned to the pre-2020 level. Comparing to the projection before 2020, There are 3.5 million Americans missing from the labor force. The Fed Chairman Jerome Powell attributes 1.5 million of these Americans to excess deaths and a decline in immigration. More important is the fact that 2 million older Americans left the labor force earlier than expected. What is the cause for this is a source of much debate, but what is very clear is that the longer these people stay away from the job market, the less employable they will become should they change their mind at a later stage. This means that the labor market will remain tight until we start to see large layoffs. So far, companies have refrained from large-scale firing of workers, partly because they're worried about not being able to hire them back down the road. In other words, it is possible that a deep recession will be necessary to ease the labor market tightness. 3, for Europe, the replacement of Russian energy with other higher-cost energy sources is a negative supply shock that will not dissipate for many years to come. This will result in a steeper Phillips curve. 4, increased defense spending will crowd out more productive private sector investment and lower productivity growth. What does stagflation mean for financial markets? It will push up the so-called R-star, higher real neutral rate of interest that equilibrates the economy in the long run, and lower equilibrium growth rate. The combination of higher real interest rates and slower economic growth means lower equity valuation. Central banks that do not have the stomach to accept slower growth will risk unanchoring inflation expectations and provide ammunition for flight to inflation-linked assets like gold and inflation index bonds. I've covered a lot of ground in this video, and there are many moving parts. I don't expect to be right about everything. The important thing to me is to build a portfolio that will generate decent volatility-adjusted returns if I'm just 60% right about what is in store in 2023. If you want to learn about how I'm constructing exactly such a portfolio, come visit us at davidwuunbound.com. Thank you for listening.